Ben, you correctly identify capital gains as an obstacle, right, to a diversified portfolio. If you've been successful in investing, taxes are the fruit of that labor. Like you're going to have to trim that tree eventually. And the question is, do you want to do that after a long bull run in the kind of market that we've been in now? I would argue, yeah, this is a great time to look at that versus do you wait for a 20 or 30% drawdown? And then the nice thing about a drawdown like that, Ben, is if you don't have your gains, you don't have to pay tax on that, right? So give me the taxes. I would argue in that direction. I would fill up low tax brackets because I think that's the gist here. And that, like I said, Ben, is the work of a competent planner over a 5 or 10 year period.
So ripping the Band-Aid off just means that's the trade-off between hoping the stock doesn't fall and then paying the taxes right away.
Yeah, I think that's it. Taxes, like I said, some people hate paying taxes more than they like making money. I would take the opposite tack here. And I think, Ben, a great time to do that would probably be rolling over the calendar, right? January 1 or so. You realize your gains early in the year, and then you can effectively deploy, let's say, a tax loss harvesting strategy, some other options that you might have to realize losses to kind of whittle down on that gain as the year progresses. I think that's an excellent way to rebalance over time.
And we've talked to other clients, too, who have, if they have a huge position, there's other options. There's other strategies you can use, like options, to sort of hedge against the stock falling. Right?
Yep.
There's a cost to those options, but there are ways you can do that without completely selling the stock as you slowly but surely get out of it and use tax loss harvesting and all those other things. So there are strategies you can employ. It's not something that you take lightly. You need someone to help you with those.
Yeah, and I would go that route, Ben, if there was a very concentration, let's say like half of the portfolio was in a single company. That didn't sound like this situation. This seemed more diversified, maybe concentrated in tech. But Ben, a couple of things that we've been looking at recently, just to throw them rapid fire, we've been looking at options like Section 351 exchange. That's something that you've seen a lot of platforms and products coming to market. That might be something to sit down and take a look at. We've been looking at exchange funds as an option. There's a 7-year holding period, right? So it comes with trade-offs, but you do get a lot of instant diversification there. Or looking at plain old tax loss harvesting and that using the other assets in your portfolio, build those around those concentrated positions and begin to whittle those down over time.